All right, welcome to Objection to the Form. This is Justin Humphreys. Today I've got Suzanne Neblett with Guaranteed Rate Mortgage. It's my understanding you're the branch manager, vice president of mortgage lending.
That's right.
Well, thank you for joining us. I know this is probably a very busy time for you.
Very.
So I wanted to talk a little bit about what a residential home buyer or somebody looking to refinance their home loan can expect during this kind of frantic time and home lending.
Sure. Well, there's a couple different things, whether it's a purchase or a refi, that can make a difference in what to expect. I would say one of the biggest things right now that we're seeing is the guideline changes as it relates to self-employed borrowers is pretty significant. So we like to have plenty of time to do due diligence when calculating income and so forth with those.
When did those guidelines change?
They changed in June, July, just a couple of months into COVID. Some of them have loosened up a bit at this point, but it's still more strenuous than it was prior to COVID. And these are Fannie Mae and Freddie Mac guidelines. It's not a guaranteed rate thing or any other lender, so we're all up against the same guideline changes and more stringent as it relates to self-employed borrowers.
Well, I want to get back into that, maybe a little bit later, because it's something that I think is interesting. And, I know a lot of kind of my colleagues are self-employed and I've heard some kind of mortgage horror stories as far as what's happened. But I guess what I wanted to begin with more of a broad strokes type look at it is, what do you see as far as kind of the factors that have caused the increase in volume right now?
Well, interest rates in March just plummeted. And so that started the refinance boom. And even before that, the purchase market, we typically say it starts to get busy in the spring, and we really kind of, it started so early. It was more January, February, rather than end of March, early April, when it starts getting extremely busy. So that, combined with the drastic drop in rates, it hasn't slowed down since, and it doesn't look like it's going to.
Guaranteed Rate's a nationwide lender, isn't it?
Yes, we are.
So how would you say the Wilmington market compares as far as new purchases compared to some of the other markets that your company deals with?
Well, we're in all 50 states, and here in Wilmington specifically, we've got number one market share by a pretty good margin. My branch will do probably close to $500 million in mortgages this year. And so if you compare that to where we're more prominent in areas like Chicago, which is where we're based, and Philadelphia, where we're huge, our numbers don't touch theirs. But for tiny little Wilmington, those are some pretty hefty numbers. And we have two offices here, by the way. So you look at both of those, take that number I'm talking about, and almost double it. It's a lot of volume going through.
And I guess what I meant by the question is whether the volume that we're seeing in Wilmington is going on the same nationwide, or I've seen a lot of kind of anecdotally, I've noticed a lot of people moving to Wilmington because they're now in a permanent work from home situation where they don't want to live in a big city anymore because they can get a home or they can get more value in Wilmington and pay a cheaper price. Or, there's some other various people have various reasons, but I didn't know if that's just kind of something anecdotally I've seen with the people I'm dealing with here, or if that's kind of a trend you're noticing nationwide.
I think that people are moving from the bigger cities like New York, Chicago, to smaller places like Wilmington, just to kind of get out of the mayhem, or like you said.
I was bringing up that a lot of people were moving from kind of bigger cities to Wilmington or similarly situated places because of the difference in price, and then maybe quality of life, or who knows. But there's really no point in paying all the taxes and making the huge payment when you could get the same value for half the price.
Oh, absolutely.
In a different location.
Yeah, we see that a lot. We see people that are buying second homes down here in anticipation of moving here permanently when they retire, even more so now with COVID than previously. That's obviously, this has always been a destination for people moving from up north and other places. I can't speak as much to to whether that's happening across the country, but I assume that people are kind of flocking from the bigger cities to the more laid back, lesser taxes when they can work from home.
What does the market look like for somebody looking for an investment property or a second home? Is it more difficult to get financing for that kind of purchase, or are the same products available as somebody looking for a primary residence?
For the most part, the same products are available. It's everything with regard to the different options, pricing, and things like that on a loan are risk-based, right? So we know that if someone has, for example, a first mortgage, a second home with a mortgage on it, and an investment property, they're more likely to if they were to go into financial distress, they're more likely to continue paying the mortgage on their home that they live in, right? An investment property would probably be the last thing that they would pay if something happened. So everything is risk-based accordingly. So in other words, you have to put more money down on a second home. You have to put more money down on an investment property, more so than you would on a primary residence. And then of course the interest rates, ours are the same on a primary and second home, but with investment properties, those are going to be a little higher as well.
For the second home situation, you mentioned that you'd have to make a larger down payment. I guess my understanding is conventional, you typically have to put at least 10% down?
We have several 3% options that are very common. A lot of people have a misconception that you have to put 5, 10, even 20% down, and you don't. And we even have 3% down options for people that are not first-time home buyers, which is also another thing that people are often surprised by. So lots of great affordable options out there.
Yeah, when I think about 3% down, I would presume that's government-backed loans, like an FHA or veterans loans. Are there different products that Guaranteed Rate has that have that 3% down payment option?
Yeah, so we've got all the government loans. So FHA, which is 3.5% down, VA, which is 0% down, USDA is also 0% down, of course, but that depends on a couple of different factors, whether the property or the borrower qualifies for those. But we've got 3% down conventional options as well, and some of them actually have reduced mortgage insurance on them, so they're a really, really great choice. Typically, if the credit is good enough, I'll put a 3% conventional beside an FHA loan and just talk through the differences and the benefits with the borrower, and we make a decision together on which makes the most sense.
Sure. And so is Guaranteed Rate a kind of considered a brokerage, or is it its own mortgage company that services its own loans and things of that nature?
So we are what's called a correspondent lender. So we have lots of different investors that we work with. The majority of what we do is direct with Fannie Mae, Freddie Mac, Ginnie Mae, all of the agencies. On the jumbo side, we've got a core of, I'd say now, probably 7 or 8 really solid investors that we work with. Most of those are the bigger banks that you'd be familiar with. And so we actually, all of our underwriting is delegated, meaning that even if the investor on the loan is going to be Wells Fargo, for example, we have Guaranteed Rate underwriters that underwrite it. It doesn't get sent out to a Wells Fargo, which is what the scenario would look like with a broker. So that's how we differ there. We have a very large servicing portfolio, so while we don't service all of our loans, we do service a large amount of them that get sold, especially to Fannie and Freddie. And I'd say over the past 6 months or so, I'm seeing that most every conventional loan that we're closing is staying with us for servicing.
And servicing, the way I understand that, is essentially collecting the payments. I guess that's what probably most people would perceive as being the owner of the loan, or that's who you would think lent you the money would be your servicer. But I've learned that that's not necessarily always the case.
That's exactly right. So typically the investor who put up the money for the mortgage is going to be one of the agencies. And the servicer of the loan is simply that. Like you said, they're there to collect payment. They're there to maintain the escrow account, for example, and pay out the taxes and insurance every year when they come due. And so they simply didn't have anything to do with the origination of the loan. They're there just to maintain the service from the time that the loan closes.
So I want to get back to kind of what somebody could expect if they're purchasing a home today. What are you kind of running into as far as turnaround times? Because I know that there's so many things that you can't control.
Sure.
It might be an appraiser, it might be an attorney on title work, or it might be underwriters backed up, or a combination of all three of those things. I mean, if you're out there looking to buy a home, how much lead time should you give for getting through the loan process?
So we place a priority on purchases just because they obviously have a definitive end date that we have to meet. And so from a timing standpoint, if it's a conventional loan, 30 days is still perfectly doable. It's pretty rare that people need to do them in less than that amount of time. But if they do, we can certainly accommodate that, especially on a conventional loan. Depending on other factors, I'd like to see 45 days on a VA loan, for example. We're seeing pretty extended turn times on VA appraisals, and all appraisals really for that matter at the moment. But when you start working with the government loans, there are a few more things throughout the process that are less in our control, like having to send the loan out to VA or to USDA to get approved even after we've underwritten it. So those are all time elements that we don't really have control over.
Understood. Well, how are you dealing with the appraisal turnaround time issue? Because I'm kind of running into that a little bit with some of the transactions we're doing, where we're seeing a lot of things getting pushed back because of the appraisals just aren't getting back in time, and a lot of various issues. I'm sure
Absolutely.
The appraisers are very busy right now.
They are. They are underwater, and I don't think they see light at the end of the tunnel. But so we have a couple of things in place to try to combat that. And one is we're able to request a rush with the appraiser, and they charge us a $200 rush fee, which the borrower pays for. Typically what I'll do is if I have someone that does have to close within, say, 25 days, and I feel like we're going to be pushing it, I'll talk to the realtors on both sides and just say, hey, here are our options. We do have the opportunity to rush it. Some borrowers will say, I don't want to pay $200 to rush it, and then I just explain, if it comes in past the due diligence, please know that you did have that option.
Well, I bought a new home last summer, and I ended up staying at the Town Place Suites because my loan didn't happen. It wasn't with y'all, but I had to. That was the only place in town I could find where I could keep my dog. Most of the hotels didn't. So we were out. Which it was kind of a little bit ambitious. We tried to pull the sell one home buy the other the same day. Well, one loan, the buyer of our home was with you guys, guaranteed rate, and their situation happened on time. I went with my bank, just my typical bank I work with, and I ended up at the Town Place Suites on Eastwood with my dog for about 4 or 5 days. So it was it was disappointing. I know those situations are stressful. When you're trying to pull all that off at the same time and wondering where you're going to go and what's going to happen with your stuff and that sort of thing. So that's good that you guys have that expedite program, because I've certainly seen that cause some problems.
The other thing that we're able to do that really helps is on purchases, we are able to have our appraisers do desktop appraisals instead of going out and actually inspecting the property. Now, that's not always ideal. We do give the option to our borrowers, and the realtors have input on that, of course. For example, if you've got a home that was fully renovated recently and the comparable homes that have sold weren't, then everybody involved in the transaction is probably going to want the appraiser to actually go into the property, but we do have that option as well, which people really appreciate, and those are extremely fast.
Well, you mentioned that you prioritize purchase transactions, so I guess but there's also a refi boom going on right now.
Absolutely. So we are locking refinances for 60, 75, 90 days, depending on the situation. What I tell borrowers is if I lock one for 75 days, I do not at all anticipate that we will use up that entire 75 days. But they are taking every bit of 45 to 60. So the way that our process works is that we don't submit except for in rare cases, we don't submit a refinance into underwriting until the appraisal comes back. So the good news is we also have a process on the refinance side where if we're refinancing, if the borrower's existing loan is with Fannie Mae and we lock them in with Fannie Mae again, the appraiser can do an exterior only appraisal. So that saves a bit of time as well because they don't have to schedule the inspection with the homeowner. And so in those cases, the appraisals typically come back pretty quickly and then the loan goes straight into underwriting. And so there are some that close within the 30 to 45 day range. I would say right now what's more typical is 45 to 60. Anything beyond that would have been caused by some rare circumstance, something that happened in the middle of the transaction.
And when you say Fannie or Freddie, so I know that those are some of the agencies. And are they the underlying investor in these loans, or how?
Yes.
Okay,
Yep.
Understood. So there's a couple terms that kind of get thrown around a lot that I kind of wanted to get into, and I'd like more clarification for myself, but I think it'd help people that are listening because sometimes they get used interchangeably, and it can lead to some confusion. The first thing I want to talk about is getting pre-qualified.
Mm-hmm.
So typically, I think from a borrower's perspective or somebody going through the process, you tend to feel like you're done once you get pre-qualified, or you feel that's from what I've seen that happens once you submit your tax documents and your pay stubs and fill out your application. What does it mean to be pre-qualified?
To be pre-qualified means that, and you talk about different terms that can be used interchangeably. Some people say pre-approval, some people say pre-qualification. Those two things can mean different things even at different companies. What we issue are called pre-approvals, and they are based on me collecting a full application, having a verbal conversation about income with self-employed borrowers. We would never issue a pre-approval without having tax returns. A lot of the loans that we do, the majority of the loans that we do not require tax returns. And we've got internal verification systems where I can verify income on a lot of borrowers without even having to collect pay stubs. So what that allows me to do is issue a pre-approval without getting a bunch of documentation from a borrower.
How do you do? Was that through the unemployment office numbers, or how are you able to verify income without?
We have verification systems in place. It's almost like pulling a credit report that shows you all of the person's debts. Different employers, a lot of times bigger employers, like the hospitals, PPD, for example, are signed up with different employer verification systems, and we pull from those.
Gotcha. But I guess that's essentially kind of a pre-screening. So that may be before your credit's been pulled.
No, we would pull your credit as part of the pre-approval process, and we're looking at three different things: credit, income, and assets. And so we don't have to fully document all of those things to issue a pre-approval, meaning we don't have to get copies of your homeowner's insurance policy if you own other properties. Little nitty-gritty things like that we collect when we go under contract and put the loan into process. When it goes to an underwriter, that's who puts their seal of approval on it and issues a loan commitment.
So you jumped to my next term, which is perfect. I was going to ask you about underwriters. So now, do the underwriters work for? Do you have your own underwriters, or is that like a third party auditor that's looking at your files or at the borrower's file?
We have our own underwriters, and so as I mentioned earlier, with USDA, for example, when we underwrite a USDA file, after the underwriter has done their initial review, it has to go to USDA, and they essentially underwrite what we have underwritten. Aside from that, everything is delegated, meaning we do the underwriting on it, even with the jumbo loans, like I mentioned earlier.
So is underwriting essentially, is it verification of the information that's in the pre-approval, or is there added layers to what an underwriter is looking at when?
Yeah, there's lots of added layers. That's a great question and a great way to put it. So yes, they are validating everything that they've told us, and that we've entered, into the application. And they're also, there are so many different guidelines and little different things with the different investors that, our goal is we would never issue a pre-approval on a loan that we aren't fully confident will close. But it is called a pre-approval for a reason, and we are not underwriters as the loan officer.
Do you ever run into situations where you pre-approve somebody but they don't make it through underwriting?
It's very rare. If I'm trying to think of a specific, I had one, that did close, never mind. It's rare.
Yeah, because I was thinking about it, and that's what was kind of frustrating for me in my Town Place Suites experience, is that I got, it was about day to close, and they said, all right, good news, you're in underwriting. I was like, wait a minute, what are you talking about? And they're like, well, we got to approve your loan. I was like, well, I thought I was approved when I submitted, because I'm self-employed, so I had to submit a ton of information. So I was like, I thought I got approved when I submitted all the information. Like, oh, no, that's, you were qualified. We were qualifying you then at that point. I was like, all right, when am I going to close? Well, I don't know. It'll be 2 to 7 days. And so then I'm out there at the, at the Town Place Suites, and it was disappointing. But I didn't understand what's going on. I was like, why did you need to see all this information if that wasn't gonna guarantee me getting the loan, or if that wasn't gonna be what was determinative?
There's really 3 stages of approvals, if you want to think of it that way. So one is pre-approval. That means we have a conversation. I run it through what's called automated underwriting, which is essentially the computer looking at all the different aspects of my application, saying, yes, this is going to be a good loan. Now you have to go back up everything that you've put in here and prove it on paper and so forth. And then the second level is the initial approval, when we have loan commitment, and that's what clears the due diligence. So when you have a due diligence date, there's 2 things that have to happen before that date. One is for the appraisal to come in, and the other is to have that loan commitment. And the loan commitment says, yes, everything looks good. We've validated, let's say, 90 to 95% of the documentation and everything that was turned in the application. And now there are 4 or 5 remaining conditions that we have to collect from the borrower. And then when we collect those items, it goes back into underwriting for what's called clear to close. And those are the 3, those words.
Well, that was the next one on my list, was clear to close. But so I guess from where you want to be as a realtor or a borrower or purchaser, you want to make sure you've got your loan commitment by the due diligence deadline.
Correct.
And so that's pretty much where I guess something could always come up in underwriting if you can't prove it. But I guess if you don't have supporting documentation, but once you get your loan commitment, is it essentially, if what you've communicated is accurate, you're going to get your loan?
Yes, it's very rare to get loan commitment and then not close on a loan. Like you said, things could potentially come up. I had someone recently that was going through a divorce, and we were trying to prove that she didn't make the mortgage payments on the house that he kept. And so, but he would not agree to give her the bank statements showing that he was paying the mortgage because it was not an amicable divorce.
Yeah, that sounds typical.
So, and we ended up working through it. And so that closed, but it is rare, and it would be something like that. Now, the other thing that can happen is there are pre-closing audits that can happen, and those are fully at random, and those can cause require more documentation. So I think, that's part of what people don't like, is when we have to go back and ask for more when they thought, hey, you already said I was good to go, but you're really not good to go until the very end.
Who initiates these audits? Is it your company, or is it the investors or the agencies?
It could be any of those.
Gotcha. Yeah, that's what I think frustrates a lot of people. And when I'm sitting down at the closing table with people, the two things that really get people worked up is the loan application, and that goes one of two different ways. Sometimes they get confused where to sign and what it is, and then the other thing is, well, the numbers aren't exactly accurate to the penny anymore because you did the application several weeks or months ago.
Sure.
And so some people, they're just like, whatever, just where do I sign? Other people are breaking out their phones and like, well, wait a minute, this says that my balance of the credit card is this, but it's really that. And it's kind of like, well, it doesn't, it's just, what I tell people is what matters is if your financial position is the same or better. That's
Sure.
what you need to know.
Yeah.
But if you bought a car, or you bought a truck or a boat or something like that, or bought new furniture the day before, then that's the kind of thing you need to update and let people know.
Absolutely.
Now I feel like that's an issue that kind of the real estate community has done a good job educating people about, because when I've probably been doing real estate since maybe 2013. I kind of switched over midway through my career, and when I first started off, I would have the guy that bought the new truck like the day before his closing and things like that. Like it had happened where that would botch deals, or another common one, which I'm kind of sympathetic towards, is the going to Rooms to Go and furnishing your house, on 0% interest, because it seems like a good deal, and you don't have, maybe you're getting a bigger house and don't have the furniture or whatever it might be, and so you want to have it ready to be moved in, but that ends up jeopardizing your credit and changing your debt to income and all that stuff, and so it seems like people are aware of that these days.
We still see it. And it all goes back to setting expectations. I have a flyer that's called Protecting Your Pre-Approval that I give people along with the pre-approval, that basically says, don't do these things, make sure you do these things. And we tell people, don't buy anything, don't open new credit cards, don't go buy a car, don't go buy a boat, don't do anything with your money without running it by me first. But it happens.
And that was the mistake I made last year. Around that time, is I opened like a zero interest card and did a balance transfer. They're like, wait a minute, what have you done? You've opened a new credit. I was like, well, yeah, I'm saving money. Like, no, this is terrible. You've changed this, and it kind of didn't make sense to me intuitively. But I guess from a auditing perspective, I mean, they don't know that I'm gonna, I guess, run up the card I just transferred over. I guess it might not show that I paid that card off on the statement yet, and there's some.
Yeah, it can do a couple of different things, and there are instances where it's really not a big deal, but it's hard to say what will and what won't be before it happens, because we don't know what that person's going to do. But if you've got somebody with a pretty tight debt to income ratio, in other words, if they add even $200 worth of debt to their monthly debt load, that's going to push them over the limit. But of course, you can go, when you go to buy a car or to buy appliances for the new house, and get a credit card at Best Buy. They don't care. They're not looking at your debt ratio. They're not, that's not part of their parameters. And so those things can affect the mortgage and put somebody over. They might be thinking, oh gosh, well, it's only $200 a month. That's not going to mess me up. But something that little can. Again, it doesn't always mess things up, but what it does always do is it always causes the need for further documentation. And that's, again, one of the biggest complaints that people, no matter the company, have with the mortgage process, is the amount of documentation that has to be collected.
I always think sometimes I like some of the explanation letters, because you'll tell that it's like a frustrated borrower who's written this, and a lot of times, like, it was one loan I had, or one closing, it was For some reason, they wanted an explanation letter about whether, because it was a self-employed person, whether the company had taken out a PPP loan. And she wrote a letter, my business is so successful, I didn't need payroll protection, or something was how she wrote that letter. And you could tell it was an annoyance thing. Why am I having to write this letter to say I didn't get a loan or something like that? It was...
And that's another thing that I think is so important, and that I try to be very clear about up front, is we're never, ever, ever going to ask you for something that we don't actually need. Yeah. And so it doesn't matter why we're asking. You don't have to understand it. I do my best to help you understand, but I had someone recently say to me, well, I've never heard of that. That doesn't make any sense. I'm not doing that. And she hadn't bought a home. She was selling her house that she lived in for 30 years. And so she hadn't done a mortgage in 30 years, and she wasn't doing something that the underwriter asked of us because it didn't make sense to her. And so, we don't want to chase down documents that we don't need, and we're not going to. So I tell people, don't ask questions. I promise we're not going to ask for a bunch of stuff that we don't need, because that just bogs down everybody.
Are you the one gathering the documents and telling the borrowers what you need, or is that an underwriting or a function of the people that are involved in that kind of auditing process?
So in the beginning, I'll give the borrowers an electronic to-do list, and they upload documents to our portal. I don't collect documents. I don't want people sending me documents, because I have an entire team of processors, one that handles the front end of the process, one that handles it after it comes out of underwriting. They're the ones that collect and manage the documents through our online system. And so that makes it easy. It's a very secure portal. There's not a lot of email back and forth, not a lot of paper pushing. And then the underwriter is the one that, after they do that initial review and issue loan commitment, they'll give us a list of the remaining items that we need, and then the processor on the back end will collect those from the borrower.
Yeah, you kind of mentioned something that with the woman that said that I've never had to do this, and that's kind of one of my pet peeves about real estate related things. I don't know how many times I've heard some variation of this statement. It's, I've been doing this for blank amount of years and I've never seen this, or and it's like, well, I'm not making it up, or it's not. I had a woman tell me she's been buying and selling properties her whole life, and she's never heard of having to sign a deed or something. I was like, it's just the way it is. I don't know how your other experiences were, but I'm not making up the deed requirement. It's nothing new. Right.
And sometimes, people, if they're stubborn and don't want to do something, I guess they just have to decide, do they want the house or not? And that's up to them. We can't make them do something, but we can't give them a loan if they don't meet the underwriting requirements.
So the final phrase on my list, and you already brought it up, clear to close. What's that mean?
That means that it's been given the final seal of approval from the underwriter. That means that all of the conditions, the documentation that we collected up front has all been signed off on. All of the documents are up to date. So in other words, if we needed a most recent pay stub, it means there are no trailing things that still have to be done. Now, there are a few items, especially with COVID, that we have to do even after the loan is clear to close. We have to collect a most recent pay stub within 5 days of closing and do a verbal verification of employment, just to show that the person still has a job, isn't furloughed or anything like that. But ultimately, clear to close means, okay, the underwriting portion of this process is done. Now it has to go into closing to get prepared to send you the package to balance the closing disclosure with you and to get that to the borrower.
So, and I'm presuming that employment verification, so that's a way that maybe the agencies put additional requirements for your traditional W-2 employee.
Yes.
But earlier when we were talking, you mentioned that some restrictions or some guidelines had changed for the self-employed. Now, I believe you said those were COVID related.
They are, and the thought behind it, and again, these are agency guidelines, is that, in the past, we would base self-employed income on prior year's tax returns. And so the agencies now say, well, they don't consider COVID to be a one-time thing of the past. They consider it to be something that's ongoing and or unknown, where it will go, obviously. And so they want to show not only past income but stability. The key is stability. So a restaurant owner, for example, did they have to shut down? Yes, they would have had to shut down for at least a couple of months, likely. And so we want to look at their income during that time, compare it to past income, compare it to a profit and loss statement for year to date, as well as the last 2 bank statements for the business. And so that's way more documentation that was traditionally needed on a conventional loan, on a conforming loan. But now we have to get all of that.
So that's something, because, and I've run into that a little bit, where it was kind of like folks have had the option of presenting a CPA audited P&L, or their QuickBooks P&L plus bank statements. And I was thinking, well, a business bank statement will tell part of the story, but it's hard to really tell from a P&L. I guess you could look at what was the balance in the beginning of the month and what was it in the end of the month. Is this company bleeding profits? I guess that'd be a pretty easy thing to tell if you're taking a 2-month picture of it.
Right, and that's what we do. We have a spreadsheet that we have to submit. We have a whole team of people that work on an income desk, and their whole job is to review self-employed income before it gets submitted into underwriting to make sure that we're using accurate numbers. And so we look at the bank statements, we look for, and we have to have a conversation with the borrower. It's pretty time consuming, but we are looking for things that are non-recurring business expenses, for example. So if they have a $5,000 payment to the IRS, we can add that back in because they're not going to be paying that every single month. Or the PPP loans, we would back that out of income because that's non-recurring income. And then of course we'd have to hit them for the debt associated with that as well. So just kind of looking through the bank statements, looking for big things that stand out that may or not be typical, and then coming up with a good income number based on those bank statements, and then looking at the P&L to make sure that that's consistent with the bank statements. Then look at the tax returns for the past 2 years and make sure that all of those are still in line. And if they're not, then you start to ask more questions about why, just to determine the stability of the income of the company.
You mentioned jumbos earlier, and from my understanding, jumbo loans are mortgages where you're getting a little bit over $500,000. I don't know the exact number.
It's $510,400.
Wow, I'm impressed that you've got that. So, what does that mean to you as a borrower if you're borrowing more than that? What is it a substantial rate hike that you're going to experience, or when you need a jumbo loan, how's that going to differ from your traditional conventional loan?
The guidelines are different with jumbo loans. They all require 2 years worth of tax returns, no matter the investor. So that's a pretty significant difference, and that's whether you're self-employed or not. I'd say from an underwriting standpoint, that's probably the biggest difference. At most lenders, you are going to see a pretty significant difference between conforming rates and jumbo. At guaranteed rate, one of the best things about our pricing is that our company gives us the option to take a reduced commission. So they say, hey, on these jumbo loans, in order to have the very best rates, if you'll cut your commission, we'll cut our revenue. And that way you can be sure that nobody will ever beat you. So I've got quite a few jumbo loans in process right now. I've got 2 different ones with 2 different loan amounts. And actually, as the loan amount gets higher, the rate gets better, which is crazy, but that's just how it works out. So I've got 2 30-year fixed locked right now, one at 2.75 and one at 2.875.
For
both
jumbos.
with 0 points on jumbo, which
Wow.
is just, it's unheard of. I mean, those are, a lot of lenders right now don't even have that on conforming loan amounts, rates that low. So it's our pricing is very, very competitive in the jumbo space.
Well, yeah, and I'd always just, it's kind of one of those kind of just things you hear. I'd always just heard that the jumbo rates were really high and that you didn't want to take out a mortgage if it was over that amount. But that sounds outstanding.
Yeah, it's another one of those myths. And again, that is very true with I would say the majority of lenders. And it's just like I was saying earlier, looking at conventional versus FHA for somebody that wants to put 3% down. If I've got somebody that is buying a house for $650,000, for example, we can look at how much it would cost to do the first mortgage at 510 400 and maybe have a second equity line or something like that to utilize for the rest of the down payment versus a jumbo. And with our pricing where it is right now, it always makes sense to do the jumbo because the rates are that good.
One of the things that's kind of been interesting to me is kind of the reluctance in North Carolina to get into the e-closing transactions. And I know that there's a big push, and Guaranteed Rate's one of them that really pushes for as much digital as possible and trying to push for paperless. What do you see as kind of the reason that hasn't really been adopted by most of the lenders doing business in North Carolina?
So we have a process that's called flash close. And essentially what that is that 95% of the closing package is signed electronically. So we send a link to the borrower the morning of closing, and they electronically sign all of the package except for the documents that have to be notarized. So there are, depending on the type of loan and the state and that type of thing, 4 or 5, maybe 6 documents that actually have to be ink signed. So that takes the closing from 60 minutes to 10 or 15 max.
Yeah, and I think that's fantastic. I love that. But what I was talking about is kind of, we have e-notary available in North Carolina, but I see the majority of I say the majority, it's 99.9. I think we had one person, one company try to utilize our e-notary services, and I was just wondering why that is, as far as if people just don't feel comfortable with it yet, or what the rationale would be. But it seemed like, I know a lot of lenders for vehicles and things like that are going to all electronic, and I was just surprised that it hadn't happened yet with the real property lenders. One of the things I think is kind of cool about Guaranteed Rate, I was watching the UFC fight last weekend, and I thought it was pretty cool that, or let's say last week, it was Saturday afternoon. I thought it was pretty cool that you guys were sponsoring the UFC and NASCAR and something, and really have a kind of a creative marketing.
Motocross.
Yeah.
You name it, we're out there.
Well, what would a lot of the folks that kind of watch this and that listen to it are attorneys? What would you like to see from the attorney? What can attorneys do to do a better job, or what advice do you have for the attorneys that are doing some transactional real estate work?
We've got great local attorneys, so we don't have a ton of complaints. So speed, accuracy, those are all that's what we're focused on all of the time, and so we hope that all of our partners are too. But as you know, there are only so many hours in the day. You can only do title searches so fast, right?
Yeah.
So I think, as it relates to any third party that we're waiting for, whether it's homeowners insurance, the appraisal, the title work, the faster we get it back, the better, just because that gives us more time to review it and make sure that what comes back on it doesn't have implications, that could further delay the loan. Gotcha.
So it's the main thing, I guess, is get your title searches done quickly.
Yes.
All right. Well, that makes sense, and I think that's certainly everybody's goal. It's been, it is kind of a busy time right now, but I think that's certainly what you want to do to move it along quickly for everybody.
Sure.
Well, I appreciate you taking time out of your busy schedule to talk to me, and I learned a lot, and I hope that the people that listened learned a lot as well. And do you have anything you want to plug, or do you have where can people reach you if they want to get a loan from Guaranteed Rate?
Absolutely. So my name again is Suzanne Neblett, and you can just Google Suzanne Neblett Guaranteed Rate. My website is rate.com/Suzanne Neblett. I'm obviously on Facebook, Instagram, all those places as well, and would love to help anybody that's thinking about buying a home or refinancing. And it's funny because even people that have bought homes within the past 6 or 8 months are already refinancing it. That's how fast the market has moved.
So I was gonna kind of outro out of this thing and wrap it up, but that brings up one question that I wanted to ask you that I forgot to ask you. So sometimes you'll hear like financial podcasts or financial advisors, and they'll say, well, you don't want to refinance a loan for the purpose of cutting your payment or reducing your interest unless you're under a certain percent reduction. Like I've heard 1/4%, 0.5%. Some people say a whole percentage point. What do you have any hard and fast rules or any advice on that issue?
I don't have any hard and fast rules. I know that some lenders do like to throw a certain number out there, but if you look at the actual numbers, it depends on so many different variables. It depends on the loan amount. It depends on how long you've had the loan. It depends on what your goal is. You know, some people don't care about how much their monthly payment is. They just want to pay it off as quickly as possible. So back to the thing about loan amount, if I can reduce $1 million loan by 0.75%, it's going to have a way bigger impact than if I reduce the rate on a $200,000 loan, for example. So in my opinion, there is no magic number. That's not everybody's opinion, but that's mine. I just kind of like to look at the entire situation and see what the goals are of the borrower and go from there, make a good decision together.
Well, that makes sense. Well, this time I really am serious. This time I really am done. So thank you for coming on. It was very nice speaking with you.
You too. Thank you.
Thanks.